Hey everyone, it's John Green here, and today we're diving into the world of credit scores. Understanding your credit score is like unlocking a secret level in the game of life. It's this little number that follows you around, and it has a surprising amount of power. Think of it like your financial GPA, a report card for lenders and businesses. A good credit score tells them you're responsible and trustworthy with money. By the end of this video, you'll be well on your way to becoming a credit score master. Let's get real for a second. You might be thinking, John, this credit score stuff sounds kind of abstract. How does it actually play out in the real world? Well, imagine this. You're finally ready to move out of your parents' basement. No judgment, we've all been there. And into your very own apartment. You find the perfect place, but guess what? The landlord wants to check your credit score. Why? Because a good credit score tells them you're more likely to pay your rent on time. It's a sign of responsibility. Now, let's say you're in the market for a new car. You've had your eye on that sleek electric vehicle that makes you feel like you're driving into the future. But when you go to finance it, the lender uses your credit score to determine your interest rate. A higher score means lower interest rates, which translates to more money in your pocket. And it doesn't stop there. Even some employers check credit scores, especially for jobs that handle money. They want to make sure you're financially responsible. So, yeah, credit scores are a pretty big deal. But here's the good news. You have the power to build a good credit score. It's not some mysterious force you have no control over. It's like a muscle you can strengthen over time with smart financial habits. This video is your guide to credit confidence. We'll walk you through the ins and outs of credit scores, giving you the knowledge and tools you need to take charge of your financial future. We'll cover everything from the different factors that make up your score to practical tips for building and maintaining good credit. And don't worry, we'll keep it clear, concise, and easy to understand, even if you've never thought about credit scores before. So whether you're just starting out on your credit journey or you're looking to level up your score, this video has got you covered. Get ready to unlock your financial potential and achieve your money goals. Let's get started. Okay, so what exactly a credit score? In the simplest terms, it's a three-digit number, typically ranging from 300 to 850. The higher the number, the better. Think of it like a video game score. You want to be racking up those points. This magic number tells lenders how risky it is to lend you money. A high score says, hey, this person's got their financial act together. They pay their bills on time and don't overspend. A low score, on the other hand, might make lenders a bit hesitant. But how is this score calculated? Well, it's based on information in your credit report, which is like your financial history book. It keeps track of things like how many credit cards you have, how much debt you owe, and whether you've paid your bills on time. Now, you might be wondering, who decides what's a good score and what's not? Great question. There are different credit scoring models, but the most common one is the FICO score. We'll dive deeper into that later on. Believe it or not, credit scores haven't always been around. It wasn't until the 1950s that a company called Fair Isaac Corporation, or FICO, developed the first credit scoring system. Before that, lenders had to rely on their gut feeling when deciding whether to give someone a loan. They'd look at things like your income, your job history, and even your character references. Talk about subjective, but with the introduction of credit scores, the lending process became much fairer and more objective. It allowed lenders to assess risk based on standardized data, making it easier for people from all walks of life to access credit. Pretty cool, huh? From a time when getting a loan was a gamble to today's data-driven system, credit scoring has come a long way. Now you might be thinking, okay, John, I get that credit scores are important for getting loans and credit cards, but what else are they good for? Well, hold on to your hats, my friends, because credit scores are making their way into other areas of our lives. Remember that apartment you were eyeing earlier? Landlords often use credit scores to screen potential tenants. They want to make sure you're responsible and likely to pay your rent on time. And it's not just landlords. Some insurance companies use credit scores to determine your premiums. The logic is that people with good credit tend to be more responsible overall, even when it comes to things like driving. Who knew? And here's the kicker. Some employers even check credit scores as part of the hiring process, especially for positions that involve handling money. They want to make sure you're financially trustworthy. So yeah, credit scores are becoming more and more important in our digital age. All right, let's break down the first and most important component of your credit score: payment history. This factor alone accounts for a whopping 35% of your score, so it's definitely not something you want to mess with. Think of it like this. Lenders want to know that you're reliable and will pay back the money they lend you. Your payment history is the best indicator of that. It tells lenders if you've paid your past credit accounts on time, which is a major green flag in the credit world. Now, what counts as a payment history? We're talking about everything from credit cards and loans to utility bills and even your cell phone bill. Yep, that's right. Even those late cell phone payments can come back to haunt you. So how do you ace this part of the credit score game? It's simple. Pay your bills on time every time. Set up automatic payments, mark those due dates in your calendar, whatever it takes. Just remember, consistency is key. Section 2, credit utilization, finding the balance. Credit utilization makes up about 30% of your credit score. It refers to how much of your available credit you're using. For example, a $1,000 limit with a $500 balance means 50% utilization. Lenders get nervous with high utilization rates. Experts recommend keeping it below 30%. Aim for a balance below $300 on a $1,000 limit. Section 3, length of credit history, the long game. Now let's talk about a factor that accounts for 15% of your credit score, length of credit history. This one's pretty straightforward. The longer you've been managing credit responsibly, the better. Think of it like this. Lenders see a long and positive credit history as a sign of financial maturity and stability. It shows them that you've been playing the credit game for a while and have a track record of making responsible decisions. Your credit history takes into account things like the age of your oldest credit account, the average age of all your accounts, and how long it's been since you've used certain accounts. The key takeaway here is that credit scores are a marathon, not a sprint. So if you're just starting out, don't sweat it. Everyone has to start somewhere. The important thing is to establish good credit habits early on and be patient. Over time, as you continue to use credit responsibly, your credit history will work in your favor. Section 4, new credit, slow and steady wins the race. New credit makes up 10% of your credit score. Opening too many new accounts can hurt your score. Each application results in a hard inquiry. These inquiries can ding your score. They stay on your report for 2 years. Be strategic about opening new credit accounts. Section 5, types of credit, mixing it up. Last but not least, we have types of credit, which accounts for the final 10% of your credit score. This component looks at the different types of credit you're using, such as credit cards, loans, and mortgages. Lenders like to see a healthy mix of credit because it demonstrates that you can manage different types of debt responsibly. Think of it like this. If you're only eating one type of food, you're missing out on important nutrients. The same goes for credit. Having a variety of credit accounts shows lenders that you're well-rounded and can handle different types of financial obligations. Now, you don't need to go out and get a mortgage just to improve your credit mix. The key is to use the credit you have responsibly and consider adding different types of credit over time as your financial situation evolves. All right, let's talk about the big cheese of credit scoring, the FICO score. This is the model you'll hear about most often, and for good reason. It's used by a whopping 90% of lenders, making it the most influential credit score out there. Developed by the Fair Isaac Corporation, remember them from our history lesson? The FICO score ranges from 300 to 850, with higher scores being the gold standard. Think of it like this. If credit scores were Hogwarts houses, a high FICO score would be like getting sorted into Gryffindor. Everyone wants in. Now here's where it gets a little more interesting. There's not just one FICO score to rule them all. There are actually different versions, each tailored for specific industries or purposes. For instance, there's a FICO score specifically for auto loans, one for credit cards, and even one for insurance companies. But don't worry, the basic principles remain the same across these versions. They all aim to assess your creditworthiness and predict how likely you are to repay borrowed money. Now, the FICO score might be the reigning champion of the credit scoring world, but it's not the only game in town. Enter VantageScore, a worthy contender developed by the three major credit bureaus themselves, Equifax, Experian, and TransUnion. Like the FICO score, VantageScore also uses a 300 to 850 range, with higher scores indicating lower risk. It aims to provide a consistent and transparent way for lenders to assess creditworthiness, regardless of which credit bureau they pull your report from. VantageScore has gained some traction over the years and is now used by a growing number of lenders. It often touts its ability to score more consumers, including those with limited credit histories, thanks to its slightly different scoring methodology. While both FICO and VantageScore use similar data points, such as your payment history and credit utilization, they weigh these factors differently. This means your FICO score and VantageScore might not be identical, even if they're generally in the same ballpark. Section 3. Beyond FICO and VantageScore. FICO and VantageScore are the most widely used credit scoring models, but there are other models with their own criteria. Some are industry-specific, like for mortgages or auto loans, for example, a FICO score for mortgage lenders. Alternative models use non-traditional data like rent payments. They offer a holistic view of your financial behavior. Different lenders use different models, so scores vary. Section 4. Navigating the score showdown. With different credit scoring models, it can feel like a credit score showdown, but understanding key differences helps you navigate this landscape. Focus on factors like payment history and credit utilization, which influence your score across most models. Good credit habits set you up for success regardless of the model a lender uses. Section 1. Unlocking your credit report. It's free. You can access your credit report from Equifax, Experian, and TransUnion once a year for free at annualcreditreport.com. Think of it as a free annual checkup for your credit health. Avoid flashy websites promising free scores with hidden fees. Regularly checking your reports helps spot errors and stay on top of your financial game. Section 2. Credit monitoring, your financial watchdog. Credit monitoring services alert you to suspicious activity or changes. They range from free basic options to paid subscriptions with extra features. Many financial institutions offer free credit monitoring as a perk. Basic services provide access to your score and alerts for major changes. Paid services offer more features like identity theft insurance and dark web monitoring. Section 3. Deciphering your credit report, a step-by-step guide. Your credit report is like a financial novel, each section a chapter of your credit story. First, check your personal information for accuracy. Next, review your credit accounts, including balances and payment history. Spot any late or missed payments that might be affecting your score. Understanding your report helps you manage your credit better. Section 4. Disputing errors, taking charge of your credit story. If you find an error on your credit report, don't panic. Gather supporting documentation and file a formal dispute with the credit bureau. Submit your dispute in writing and keep a copy for your records. The bureau has 30 days to investigate and respond. Correcting errors can boost your credit score. Paying your bills on time is crucial for good credit. Payment history accounts for 35% of your score. Even one late payment can significantly impact your score. Set up automatic payments to avoid late fees. Staying organized helps you maintain a strong credit history. Credit cards offer convenience and rewards, but can lead to debt. Credit utilization makes up 30% of your score. Use your credit limit wisely, like dipping your toes in a pool. Create a budget and only charge what you can pay off in full each month. Responsible use keeps your credit utilization in check. Hard inquiries can temporarily ding your credit score. They occur when a lender checks your credit for a loan or credit card application. A few inquiries won't derail your score, but too many can raise red flags. Avoid unnecessary inquiries by checking if a lender offers pre-qualification. This helps keep your credit score clean. Section 4. Building a credit-healthy lifestyle. Building and maintaining good credit is an ongoing journey. It takes time, consistency, and financial discipline. Stay informed and keep learning about credit trends and best practices. Good credit habits lead to long-term financial health. Section 1. Credit cards, friend or foe. Credit cards can be valuable tools if used responsibly. They offer convenience and rewards and help build good credit. On-time payments and low balances demonstrate trustworthiness, but they can become debt traps if not managed carefully. Avoid minimum payments to prevent long-term debt. Section 2. Juggling multiple accounts like a pro. Managing multiple credit cards requires focus and strategic planning. Keep track of all your due dates to avoid missed payments. Use digital calendars or reminders to stay organized. Find a system that works for you and stick to it. Good credit unlocks exclusive perks and financial opportunities. A good score increases your chances of getting approved for loans and rentals. Landlords and lenders favor responsible financial behavior. Excellent credit scores lead to better interest rates and terms. Enjoy the benefits of your hard-earned credit status. Section 4. Building blocks for credit newbies. Starting out, use tools like secured credit cards to build credit. Secured cards require a deposit, making approval easier. Responsible use builds a positive credit history. This paves the way for traditional credit cards in the future. Section 1. Busting credit myths. Don't fall for these financial fables. Checking your credit score won't lower it. It's a soft inquiry. This myth is as old as your grandma's fruitcake recipe. Checking your score gives you a clear view without impacting it. Separate fact from fiction to make smart financial decisions. Section 2. Credit score truths. Separating fact from fiction. Closing old credit accounts won't necessarily improve your score. Length of credit history is important. Old accounts add to it. A long credit history shows financial maturity and stability. Keep old accounts open to maintain a strong credit history. Section 1. Level up your life and master your credit. And there you have it, Credit Crusaders. We've journeyed through the ins and outs of credit scores, from their historical roots to those confusing myths that just won't quit. Remember that feeling when you finally beat that super hard level in your favorite video game? That's the feeling of being in control of your credit. It's not about being rich or having tons of credit cards. It's about making smart choices that set you up for financial success. Think about your long-term goals. Want to buy a house, start a business, travel the world? A good credit score can be your passport to those dreams, opening doors to better loan terms, lower interest rates, and more financial freedom. So keep those on-time payments flowing, tame that credit card beast, and monitor your credit report like a hawk. Your future self will thank you. Remember, the power to shape your financial destiny is in your hands. Now go forth and conquer the credit